We are going to cover 5 nuances related to consolidated financial statements. These are 5 items that you want to take into consideration when you're working with multiple entities that you're consolidating together. These are going to be operational and accounting considerations. Let's dive into this. Here we go. Nuance number 1, we're going to look at an intercompany balancing report. This is where you compare the intercompany receivable and the intercompany payable between different entities to make sure they match. Because if they don't match, if your intercompany receivable and your intercompany payable do not match, more than likely you have a transaction missing on one side. And this report will help you identify where they do not balance. This is where you have a parent operating with subsidiaries. So if a parent allocates expenses to a subsidiary, there's going to be an intercompany receivable, and the sub's going to have intercompany payable, and they should equal, because when you consolidate all the entities into one economic entity, you're going to eliminate the intercompany receivable and payable, and if they do not equal, you're going to have a leftover balance, and that is incorrect. So the intercompany balancing report will help you identify if there's something out of balance, and then if you see something out of balance, as we have in this example here, we're going to run the detailed GL to see what is missing. And in this very simple example, we have a transaction that's on the parent, but the other side of the entry is not on the sub LLC in this example. So we got to look and see why that journal entry is hung up. Make sure that journal entry gets posted. And once that journal entry gets posted, our intercompany receivable and our intercompany payable between the parent and the subsidiary are going to agree. And when we consolidate the entities together, the intercompany receivable and payable will eliminate to 0. Nuance number 2, foreign currency considerations. In this situation, we're going to compare an intercompany payable to an intercompany receivable. And the intercompany payable is on the foreign sub. It's going to be in British pounds. The intercompany receivable is on the parent. That is in US dollars. So when we convert the British pounds to dollars, we're going to use the spot rate as of the date we're running the report. This is a 12/31/24 report. The spot rate that I have made up, 1.35. So we're taking our 25,000 British pounds, our intercompany payable balance, and we're multiplying it by 1.35, the spot rate for pounds to USD, and we're coming up with $33,750. Now we're going to compare that to our intercompany receivable on the parent's books of $35,000, and we have a difference. In this situation, we need to post a journal entry so the intercompany payable and the intercompany receivable balance. Now, since the sub owes the parent less money in this situation upon conversion, the parent is going to recognize a foreign currency loss so we can balance the payable and the receivable. We're going to post the journal entry to debit foreign currency loss of $1,250. We're then going to credit the intercompany receivable to bring it down to $33,750. And now when we consolidate the sub into the parent into one economic entity, the intercompany balances will net to 0. Nuance number 3, non-controlling interest. Now, this is going to happen when you have a subsidiary that you don't own 100% of. So in this example here, sub LLC, we own 75%, or the parent owns 75% of that entity. And when you only own 75% of an entity, you need to back out the income that is not owned by the parent. And this is considered non-controlling interest. It's fairly simple here. We're just going to take sub LLC's net income. We're going to multiply it by 25 or negative 25%. And when we consolidate all these entities together into one economic entity, we're going to have this non-controlling interest income line of $82,500, which simply represents 25% of sub LLC's net income that the parent Inc. does not own. Nuance number 4, paymasters and service agreements. Now, a lot of times when you have multiple entities transacting together, or you have multiple entities that are consolidating together, you're going to have one entity that ultimately ends up being the paymaster, especially related to payroll costs. Not every setup is like this, but a lot of times you will see a paymaster. So what a paymaster will do is they're going to have the main operating account. they are going to be the entity paying payroll. They are the entity that's going to be paying a lot of the accounts payable. And when you have that situation, that paymaster is going to allocate those expenses to other legal entities within the consolidated financial statements. One, you're going to want to have service agreements in place to identify what costs are being allocated to what entities. That's clean, that sets proper expectations. Auditors are going to ask for those. This will determine what expenses can get allocated to what entities, and then ultimately how they get paid back. We'll get to that in a second. And then also when you're doing this, there's going to be journal entries when items are paid, either through your accounts payable system, through recording payroll, ADP download. These journal entries are going to allocate certain expenses from the paymaster to the subsidiary. And when that happens, you're going to have the intercompany receivable payable impact to those as well, because you're going to be hitting an expense on the sub. The cash is going to be leaving the paymaster, and the intercompany and receivable and payable are going to be the matching parts of the equation related to the subsidiary and the parent, and ultimately they'll get eliminated when you consolidate them all into one economic entity. In the example presented here, we are allocating payroll costs to two subsidiaries from the parent incorporated. Parent incorporated in this example is the paymaster, and these are the journal entries that are used to allocate the payroll costs coming out of the parent incorporated's operating account and then pushing down the expense to the subsidiary. And you can see the intercompany receivable and payable transactions that are happening when these payroll costs get allocated out to the subsidiaries. Nuance number 5, settling intercompany transactions. So going back to the paymaster scenario, the parent incorporated is the paymaster. They have put out the money to cover the payroll costs that have been allocated to the subsidiary. Now the subsidiary has a payable to parent incorporated. Parent incorporated has a receivable from the subsidiary. How does that get settled? How that gets settled is either you transact back with the entity or you send cash. In this scenario, we're going to assume the subsidiaries are sending cash back to the parent to settle the intercompany relationship. And this is where you want to look back to your intercompany service agreement that I mentioned earlier. Those are important to have in place when you're transacting between different legal entities. And this is just a simple example. We are going to look at our intercompany payables on the subsidiaries, and we're just going to send cash back to the parent to settle those intercompany balances. So sub LLC in this situation, they're sending money from their operating account, GL1001. They're sending $25,000 from that account. They're going to zero out their intercompany payable to the parent, and then the parent is going to get that money. It's going to transfer into the parent's operating account, 1002. And they're going to offset the intercompany receivable from the subsidiary. And at the end of the day, the intercompany balance between these entities is 0. You don't even have to worry about eliminating them at this point. And that is how you would settle intercompany balances between sub and parent, or intercompany balances between different entities. All right, that's 5 nuances related to consolidation accounting. Hope you learned something out of this. Have a good rest of the day, and I will see you in the next video. Take care, and goodbye. Yeah.